Last week, Canadian financial markets presented investors with a truly paradoxical landscape. The S&P/TSX Composite notched its eighth consecutive record high, signaling apparent market strength. Yet, beneath this impressive headline, deep structural concerns and urgent monetary policy recalibration are clearly evident. The abrupt shift in market expectations was triggered by devastating August employment data. Canada lost 65,500 jobs, marking the steepest monthly decline since January 2022. This pushed the unemployment rate to 7.1%, its highest level since May 2016. This deterioration fundamentally altered the outlook for the Bank of Canada, BOC. Before the report, markets priced a 60% chance of a September rate cut. Within hours, those odds surged above 90%, reflecting a dramatic reassessment of economic conditions. Traders now anticipate an aggressive easing path from the BOC. The overnight rate is projected to fall from the current 2.75% to 2.50% this September, then to 2.25% by December. Further cuts are expected, reaching 2.0% by March 2026, signaling a significant dovish pivot. The market reaction underscored a significant pivot in Canadian asset drivers. Traditionally, the Canadian dollar's performance closely tracked oil prices. However, that correlation broke down as crude tumbled 8.5% on OPEC supply concerns. Instead, rate differentials have emerged as the primary driver of FX dynamics. The loonie weakened 0.6% to 1.3822 against the US dollar, despite broad USD softness. This reflects growing investor unease about Canada-specific growth risks and the anticipated divergence in monetary policy. Commodities added another layer of complexity to the market narrative. While oil slumped, gold soared past $3,600 to fresh record highs. Investors sought safety amid rising global and domestic uncertainty, highlighting gold's role as a traditional hedge. Interestingly, Canadian bank stocks bucked expectations by rallying into the prospect of rate cuts. This suggests that markets anticipate looser monetary conditions could cushion credit growth and support the financial sector. This resilience offers a nuanced perspective for equity investors. The week's events have profoundly reframed Canada's economic narrative. What was once seen as a gradual, uneven recovery is now viewed through the lens of policy urgency. All eyes are on the September 16-17 window, when both inflation data and the BOC's policy decision converge. Governor Tiff Macklem has signaled that labor market slack and trade uncertainty warrant an accommodative stance. This suggests the central bank's dovish tilt is not merely reactive, but a strategic move to stabilize the economy. Investors should closely monitor BOC communications for further guidance. In summary, Canada's markets are riding record highs, even as warning lights flash across employment, currency, and commodities. Whether the BOC's imminent easing cycle proves prescient or premature will depend on the delicate balance between stabilizing growth and avoiding financial excess. For now, investors face an environment defined by both opportunity and heightened risk. Stay informed and subscribe for more in-depth market analysis and financial news. Engage with us in the comments below to share your insights on Canada's economic outlook.
Thanks for watching. That's all for today's update. And don't forget to like, subscribe, and hit the notification bell for more in-depth market analysis. See you next time.